What if everything you thought you knew about silver was wrong? I'm standing here in a coin shop in December 2025, and I just heard something that made my jaw drop. A veteran bullion dealer with 40 years in the business just told me he thinks silver could hit $150 an ounce within the next 18 months. Not 70, not 80, $150. Now, before you roll your eyes and click away, hear me out. This isn't some random guy on the internet. This is a dealer who's lived through the Hunt Brothers squeeze in 1980, the 2011 spike to $49, and every boom and bust in between. And what he's seeing right now, he says, is different from anything he's witnessed in 4 decades. Let me back up for a second. You know that feeling when something big is happening, but most people haven't noticed yet? Like you're watching a slow-motion car crash and you're the only one who sees it coming? That's exactly what this feels like. Silver just did something it hasn't done in over 40 years. In late 2024 and early 2025, it broke through multiple resistance levels that it held for years: 35, 40, 45. By December 2025, it touched $63 an ounce. Some dealers are reporting local spot prices even higher because physical metal is so hard to find. But here's what nobody's talking about. While everyone was focused on that price action, something much more significant was happening behind the scenes. The physical market completely disconnected from the paper market. Let me explain what that means. For decades, silver prices have been set primarily by futures contracts traded on exchanges like the COMEX in New York. It's a paper market. People buying and selling contracts that represent silver, but most of those contracts never result in actual physical delivery. It's like betting on the price of a house without ever intending to live in it. But throughout 2025, something broke. The Shanghai Gold Exchange, which deals primarily in physical metal, started showing prices consistently $3 to $5 higher than COMEX. That spread hit $7 at times in November and December. In the silver world, that's absolutely massive. Why does this matter? Because it means the paper market is losing its grip on price discovery. The real world, where people actually want to hold physical silver in their hands, is starting to set its own price. And that real-world price is higher, much higher. I talked to 3 different dealers in 3 different states over the past 2 weeks. All of them told me the same thing. They cannot keep silver in stock. One shop owner in Texas said he's paying $3 over spot to his wholesalers just to get enough inventory to meet demand. Another dealer in Arizona said his normal suppliers are rationed to only 150 ounces per week. A third dealer in Nevada told me he drove 6 hours round trip to pick up 500 ounces from another shop because his wholesalers were completely dry. Now here's where it gets interesting. This isn't retail FOMO like we saw during COVID. Back in 2020 and 2021, it was mostly small retail buyers panic buying because they were scared. Premiums on Silver Eagles went crazy, hitting $15 over spot at times. But the wholesale market stayed relatively normal. This time is different. The tightness is at the wholesale level. The big players, the guys moving monster boxes and 1,000-ounce bars, they're the ones struggling to source metal. Retail is actually dealing with supply issues too, but the institutional buyers are quietly vacuuming up everything they can find. So who's buying? That's the $150 question, literally. In early 2024, major Indian refineries announced they were having trouble sourcing enough silver to meet manufacturing demand. India is the world's second-largest consumer of silver, using it primarily for solar panels, electronics, and jewelry. They import roughly 6,000 tons per year. Throughout 2025, the scramble has only intensified. Then, in mid-2024, Chinese battery manufacturers began placing massive orders for silver for their next-generation solid-state battery production. We're talking hundreds of tons. At current prices, these are multi-billion-dollar commitments for batteries. Most people don't realize this, but silver is absolutely critical for the green energy transition everyone keeps talking about. Every solar panel uses about 20 grams of silver. Electric vehicle manufacturers are increasing silver usage in their battery systems and electrical components. Wind turbines use silver in their electrical systems. 5G infrastructure eats up massive amounts of silver for its conductivity properties. The Silver Institute estimated that industrial demand for silver reached approximately 680 million ounces in 2024, with projections for 2025 showing continued growth. Solar alone is accounting for over 170 million ounces. But here's the kicker. Global mine production is struggling to keep pace, hovering around 840 million ounces. Do the math. Industrial demand alone is eating up over 80% of all newly mined silver. Add in investment demand and jewelry, and you're running a significant deficit. The only way the market stays balanced is by recycling old silver and drawing down existing stockpiles. But those stockpiles are getting dangerously thin. The COMEX has reported registered silver inventories, that's the metal available for immediate delivery, dropping significantly throughout 2025. We've seen draws of millions of ounces month after month. The deliverable silver keeps vanishing from the exchange at an alarming rate. Now, I want to show you something that might blow your mind. In 2024, a relatively unknown event happened that barely made the news. The London Bullion Market Association, that's the organization that essentially runs the global precious metals market, they updated their silver lending rates for the first time in decades. Why? Because there wasn't enough physical silver available to lend. Think about that. The organizations that are supposed to have massive stockpiles of silver to lend to industrial users, they're running low. Banks that normally lend silver to manufacturers so they can maintain production without tying up cash, those banks are saying, "Sorry, we don't have enough metal to lend you." When you can't borrow silver anymore, you have to buy it outright. And when everyone has to buy it outright at the same time, well, you can imagine what happens to the price. But wait, there's more. And this is where the dealer's $150 prediction starts to make sense. In 2024, we saw multiple supply disruptions that continued into 2025. Several major producing countries faced challenges. Environmental regulations tightened in Mexico, the world's largest silver producer, which produces over 200 million ounces annually. New mining restrictions and permit delays have created uncertainty about future production levels. Peru, the second-largest producer, has been dealing with ongoing social unrest and protests at major mining sites. Production interruptions have become more frequent, with strikes and blockades affecting output throughout 2024 and into 2025. Add it all up, and you're looking at a supply crunch that's only getting tighter as we head into 2026. Now, here's where the dealer's analysis gets really interesting. He pulled out a chart, an actual physical printed chart showing the gold-to-silver ratio over the past 50 years. Right now, that ratio is sitting in the mid-80s to low 90s range, depending on the day. That means it takes roughly 85 to 90 ounces of silver to equal the value of 1 ounce of gold. Historically, he explained, that ratio averages closer to 60 to 1. During peak silver demand periods, it's dropped as low as 30 to 1. In 1980, during the Hunt brothers situation, it briefly touched 15 to 1. He tapped the chart with his finger. If gold stays around $2,700 to $2,800, which is roughly where it's been trading in late 2025, and the ratio reverts to 60 to 1, silver needs to be at $45 to $46. If it goes to 50 to 1, silver needs to be at $54 to $56. If we see a real supply crisis and it drops to 30 to 1, silver needs to be at $90. But here's his thesis for 150. He thinks gold is going significantly higher too. He's not alone in that prediction. Several major investment banks have issued reports in 2025 calling for gold to hit $3,000 to $3,500 by 2026 or early 2027. If gold hits $3,000 and the silver ratio drops to just 50 to 1, not even historically tight, just moderately tight, silver needs to be at $60. If gold hits $3,500 and the ratio drops to 40 to 1, which happened as recently as 2011, silver needs to be at $87.50. But if gold hits $4,000, which is approaching its inflation-adjusted all-time high from 1980, and if silver sees a real shortage-driven spike that pushes the ratio to 30 to 1, you get silver at $133. His $150 target assumes gold gets to around 4,000 to 4,200, and the ratio drops to around 28 to 1. Is that extreme? Yes. Is it impossible? According to history, no. But let's talk about what could make this happen versus what could kill it. The bull case, the scenario where silver explodes higher, rests on several dominoes falling in sequence. First, industrial demand continues to accelerate. The International Energy Agency projects that solar installations will continue growing substantially in 2026. If projections hold, solar demand alone could exceed 220 million ounces of silver. That represents a significant increase from current levels. Second, investment demand picks up dramatically. Right now, investment demand is stronger than it was in 2023 and early 2024, but still below the peaks we saw in 2020 and 2021. Silver ETFs saw significant inflows in the second half of 2024 and throughout 2025. The largest silver ETF, ticker symbol SLV, has seen substantial accumulation. If investment demand accelerates to 2020 levels or beyond, that's potentially another 100 million plus ounces of demand hitting the market. Third, a currency crisis or inflation resurgence. Central banks have been navigating complex monetary policy decisions. When real interest rates, that's the interest rate minus inflation, when those turn negative or stay low, precious metals become more attractive because they don't lose value to inflation the way cash does. Fourth, a derivative unwind. This is the nuclear option that nobody wants to talk about. There are billions of ounces of silver represented in paper contracts on exchanges around the world. If a large institution or bank that's short silver, meaning they've sold contracts betting the price will go down, if they get caught in a short squeeze and can't deliver physical metal, it could trigger a cascade. Other shorts would rush to cover, driving the price parabolic. It's happened before. It could happen again. The bear case, the scenario where silver disappoints and potentially crashes, has its own set of triggers. First, a global recession. If the economy truly tanks, industrial demand could fall off a cliff. Manufacturing slows, solar installations get delayed, and suddenly that industrial demand drops significantly. Price follows demand. Second, a strengthening U.S. dollar. Silver is priced in dollars globally. When the dollar strengthens against other currencies, it makes silver more expensive for non-U.S. buyers, which reduces demand. If the dollar index rallies hard, it could put significant pressure on silver prices. Third, new supply coming online. There are several large silver mining projects scheduled to begin production in late 2025, 2026, and 2027. If those ramp up faster than expected and don't face regulatory or operational delays, they could ease the supply tightness. Fourth, demand destruction through substitution. If silver gets too expensive, manufacturers will look for alternatives. There are already companies working on solar cells that use less silver or different materials entirely. Battery technologies are evolving. If those technologies scale faster than expected, industrial demand could plateau or even decline. So what are the key levels traders are watching? On the downside, there's major support around $55 to $58. This level has been tested multiple times in late 2025 and generally held. Below that, the $50 psychological level represents a significant support zone. If silver falls back below 50, it would suggest the current rally is losing momentum and could lead to a retest of the mid-40s range. On the upside, the obvious level everyone's watching is $70. It's a major psychological barrier and represents uncharted territory for silver in the modern era. Silver briefly approached this level in December 2025, but hasn't broken through cleanly yet. A solid break and hold above 70, meaning it stays there for at least several days to a week, would be a major technical signal that could attract significant momentum buyers and mainstream attention. Beyond that, $85 to $90 is the next target zone. There's no historical resistance there because silver has never traded at these levels in modern history, but it represents the next psychological milestone and would put silver at half of its inflation-adjusted 1980 high. And then, if things really get crazy, $100 becomes the target that everyone's watching. Not because of technicals, but because it's a massive psychological barrier. Breaking into triple digits would likely bring in a wave of mainstream media attention and FOMO that could fuel the next explosive leg higher. The dealer I spoke with, the one predicting 150, he says the move won't be linear. It'll be violent. Sharp rallies followed by brutal corrections. Whipsaws that shake out weak hands. He's seen it before. In 1979 and 1980, silver went from $6 to $50 in less than a year. But it didn't go straight up. It had 20 to 30% corrections along the way that made people think the rally was over. He also said something that stuck with me. He said most investors aren't ready for what's coming because they don't understand the physical market. They're used to trading stocks and ETFs where liquidity is never an issue. But with physical silver, especially coins and small bars, when demand spikes, you literally cannot buy it at any price. Premiums go insane. Delivery times stretch to weeks or months. And when the mania really hits, dealers stop selling altogether because they know they can't replace their inventory. That's what happened in March 2020. That's what happened in early 2021. And he thinks it's about to happen again, but much bigger this time. Is he right? I don't know. Nobody knows. This isn't financial advice. I'm just sharing what I'm hearing from people who live and breathe this market every single day. But I'll tell you what I find compelling. The fundamentals have never been this tight in the modern era. The supply-demand imbalance is real and measurable. The industrial use case is growing exponentially, not shrinking. And the paper market, that's controlled price discovery for decades, is showing serious cracks. Whether that leads to $150 silver or not, I can't say. But something significant is definitely happening. And if you're paying attention to precious metals, you can feel the tension building. The question isn't whether silver goes higher from current levels around $63. The question is how much higher and how fast, and whether you're positioned, either physically or mentally, for what could be a historic move. One more thing the dealer mentioned that I found fascinating. He said to watch what central banks do with gold. In 2024 and 2025, central banks have been net buyers of gold at record levels. Countries like China, Russia, India, Turkey, and Poland have been accumulating gold reserves aggressively. When central banks buy gold, it signals they're worried about currency stability and inflation. And historically, when gold runs, silver follows. But silver tends to move with more volatility, both up and down. He also pointed out an interesting pattern. In every major precious metals bull market, silver lags gold initially. Gold makes its move first. Then, as the bull market matures, silver catches up and eventually outperforms gold on a percentage basis. We saw this in the 1970s. We saw it in the mid-2000s leading to 2011. And he believes we're seeing the early stages of it now. If gold is already at $2,700 to $2,800 and silver is at 63, that's a ratio of about 44 to 1. That's already tighter than the historical average. But if this bull market follows the pattern of previous ones, that ratio could compress much further. That's where his $150 target comes from. It's not just about silver. It's about the entire precious metals complex repricing higher and the ratio compressing as silver catches up. So what do you think? Is $150 silver realistic or just hype? Have you noticed the tightness in physical markets where you live? Are you seeing premiums spike at your local coin shop? Drop a comment below and let me know what you're seeing on the ground. And if you found this analysis valuable, hit that subscribe button because we're going to keep tracking this story as it unfolds. This could be the biggest move in silver we see in our lifetimes, and you definitely won't want to miss what happens next.